Hey everybody, welcome in to another daily editorial here on the KE Report. I'm chatting with Jordan Roy-Byrne. He is the founder and editor of The Daily Gold. So Jordan and I are going to be focusing a bit more on the precious metals moves, more in the short-term sense, because we have seen some crazy volatility last week, this week, really over the past couple months. But on the weekend show, I am also going to be featuring Jordan, and we're going to be taking a step back, and he's going to be sharing some of the key technical factors that he watches, not just on the charts right now, but really on every chart when he takes a look at metals and other sectors. So everyone keep an eye out for that in the second hour of the weekend show this weekend. Jordan, let's talk about this volatility, starting off with gold. Gold went through a bit of a pop last week on around Wednesday, I think it was. It had a lot of people excited. It technically did break that downtrend line that's been in place ever since the peak in early August. However, Monday changed that whole narrative as gold dropped pretty much $100. Recovered a little bit at the end of the day. Give us a recap of now whether you're viewing the metals as being in a strength position, a weakness position. How are you balancing out this volatility?
Well, I think where we are with the metals, Corey, is now lower lows are potentially back in play, especially when you look at gold, which, I mean, it came down to 1850, which is at the end of September, it was bouncing along 1850. And then the low, I believe, October 29th or 30th, that was pretty low to, or pretty close to 1850, but not quite as low. So gold has come down just below that, and over the last 2 or 3 days, 1850 again has been support. So we have to keep that level in mind, because if gold makes another move lower, I think that could lead to the low for the correction. I mean, we talked about it before. You got the 200-day in the high 1700s. You got the Fibonacci retracement in that area. So there's a lot of support if gold were to move lower. Now, silver, and despite the fact that gold is probing along its bottom along 1850, there are some positives, which I know we'll talk about. And one of them is silver, which, I mean, it's nowhere close to its lows. You look at, even if we just go by closing prices, the low is looks like around 23, maybe. It looks like it's around 23. So silver now is trading at 24.25. So silver I want to say comfortably above, but gold's probing along its bottom. Silver still has some room to go before it tests that corrective bottom support. So silver has been holding up better than gold. That's just, one of the positive signs we're seeing, despite the fact that more selling for the metals is definitely a possibility at some point.
So, Jordan, is it fair to say, too, that the gold stocks are also holding up better than the underlying metal? Even though you look at something like GDX and GDXJ, they're still in a general downtrend, but it's not a very aggressive downtrend. And you look at some of those lows ever since August, they've been a mixed bag of lower lows, but also some higher lows.
Yeah, I mean, I would also point that out, that yes, the miners have held up better, because again, gold's probing along its bottom there, and that started to happen 2 days ago, and 2 days ago, GX and GDXJ were a good distance away from their lows on October 29th, and yes, they've come down, but they're still not quite there yet. So that is some relative strength that we've seen in the stocks. And the other thing I want to mention is the Dow Jones U.S. Gold Mining Index, which is weighted heavily towards the absolute largest companies in the sector. So that's Barrick, Newmont, even Franco has a really high weighting, even though it's a royalty company, not a miner. But anyway, if you look at that chart, that's been holding up really well, and that's not that close to its October 29th low. I mean, there's some good distance there. So the largest companies are holding up the best. So yeah, even though I hardly sound optimistic about the metals, the fact that gold you could say, is the weakest part of the sector, that's a good sign, because when gold's the strongest part of the sector and everything's going down, that's usually a bad sign. But when it's the opposite, that tells you there's some strength in the market and that the correction is probably, I mean, I don't want to say it's going to end immediately, but we're 3 months into it, and we're at some point we could be getting to the later stages, and so it's a good sign that the rest of the sector is holding up better than gold.
Jordan, is it fair to say, though, that especially when it comes to the stocks, that they're being held up because of the fact that the U.S. markets are also doing so well? It's been a bit of a trend here where we've seen good days for markets. That money also goes into metal stocks.
Yeah, that's a very good point. When the stocks hold up better, or I should say, when the stock market is doing well, or it's in a period of where it's rising and trending higher, alongside a general bull market in precious metals, that helps. That helps the stocks. So that, yes, that could be the reason why the stocks are holding up much better than the metals.
Now, do you think that's sustainable? Like, is this actually a good sign? Is this good that U.S. markets are doing so well that it's holding up the metal stocks and it's giving time for, let's say, gold to correct a little bit more? Or is there something bigger going on here where we need to be focusing on the gold price and the continued correction?
Well, what I would focus on is gold against the stock market, GDX against the stock market, because those ratios have been lagging. I know they've come down a lot more in the last week or so. So, yeah, I mean, to your point, we're not going to see some massive move higher in precious metals if the stock market is doing really well. I mean, it has to correct and cool off, and we have to see the stocks outperforming the stock market. Until that happens, or until that is in a position to happen, that's you're just not going to see the stock market drag GDX and GDXJ, to the next leg higher and much, much higher after that. There has to be relative strength in precious metals for them to make that, next impulsive leg higher, where they go higher and then they sustain it and they go higher and higher after that.
Yeah, fair enough. But you know what? A lot of the gold bugs have been talking about just how undervalued the stocks are to the underlying metal. I've even been saying that, and it is true. You look at the recent peaks in gold compared to history and where GDX and GDXJ are trading, they are still much lower. That is GDX and GDXJ much lower than where they were when gold was back at, let's say, 1900, even though it was for such a short period of time. Is this kind of a natural correction that we need to see where maybe the stocks won't be screaming higher to play catch up to gold, but gold could drift a little bit to reset a bit of that gold to gold stock ratio?
I mean, it's possible. There's two or three things I could mention here. So the one negative thing we have to keep in mind with this ratio is that a lot of these companies, the reason, I don't want to get too deep into it, but one thing to remember is a lot of these companies, there's big time share dilution. And so just imagine when we were in the bear market and companies were struggling, and they still have to raise money to continue to function. And so that's why some of these ratios are so out of whack with respect to the gold stocks and their value compared to other things. Now, looking at GDX against gold, for example, this ratio in recent months has pulled back from what looks to be about 7 or even 8 year resistance. So if you pull up like a 15-year chart of GDX against gold, it has a 7 to 8 year base, and so it's just pulling back from that base. So at some point, Corey, I think in the next 12 months or so, you will see a big time breakout in this ratio, which means that gold stocks are really, really going to outperform gold. And the one comparison I can give you, one historical marker, is in 2009, after we had the initial rebound, when we got to the middle of 2009 and we had that correction, the stocks actually made a new high before gold did. And so they were really outperforming gold. And I know the stock market, yes, it was strong, it was rebounding, but I mean, that's potentially another scenario we could see where we potentially see GDX breaking to its next high before gold does. I mean, if we get to a gold price of, I mean, the high was just below 2,100. In other words, I think if we see gold, by the time it gets back to 2,100, it's possible that GDX could be breaking out first and leading gold for the next leg higher. Because if you're at 20, you're at 2,100 or 22 or 2,300, I, I mean, that's just a fantastic setup for the entire sector. And you're going to see, in my opinion, the stocks really, really dramatically outperform on the next leg higher. And then, as I said earlier in this answer, the GDX to gold ratio is just showing you that's possible with the 7-8 year setup that it has.
Okay. Hey, that's very encouraging, Jordan. We're going to leave it there, and I'm going to save a couple more questions for our weekend segment. So everybody be sure to tune in on the weekend show, as I know a lot of you do, as Jordan and I are going to go through a bit more of the basics of the technical analysis that he uses. And quite frankly, I think Jordan is one of the best technicians we have on the show. So, Jordan, appreciate your time today, buddy, and appreciate your time on the upcoming weekend show. Have a great rest of your week.